Hi, my name is Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand Forex, gold, and S&P fundamental and technical analysis for the week ahead starting the 19th of May. And I hope you all had a great trading week. And please don't forget to like, subscribe, and share the content that I provide if you find it useful. So, getting into the week ahead, and it will be a relatively quiet week in the US with attention focused on developments surrounding tariffs, speeches by several Federal Reserve officials, and the release of S&P Global Manufacturing and Services PMIs, along with data on existing and new home sales. Globally, S&P global PMI data will be closely watched for Australia, Japan, Germany, and the Euro area and the UK. In China, key economic indicators include industrial production and the pivotal interest rate decision. Japan is set to publish inflation data and trade balance. Germany will release the LFO business climate index, while the UK will report retail sales and inflation data. Canada will issue updates on retail sales, inflation, and housing prices. Meanwhile, Australia's central bank will announce its interest rate decision, and that is from Trading Economics. And we've actually started off the week with a little bit of a bang when it comes to the Moody's downgrade, which we'll get into in a sec. But starting off on the VIX, the volatility index, and really the VIX is just a measure of risk sentiment and volatility. So when the VIX is really kind of rises above 20. We get a lot of volatility and a lot of fear, uncertainty in the market. And if it's below, we tend to get more risk on environment, right? So there's traders, investors are more concerned about yield in a risk on environment, in a risk off environment. It's more about protecting what you have, flight to safety, right? And at the moment, we're hovering around the 20 area around here. So what does that really mean? That kind of means from a risk on, risk off scale, 20 being a bit more on the neutral side, right? So there are still fears, but it's more of a balance, right? We're not out of the woods yet. There's still things to be concerned about. Extreme risk off, would be, of course, where we were about a month ago with the tariff uncertainty. Extreme risk on would be where there's really no fears in the market, nothing to kind of really worry about. So we're still in that kind of cautious neutral zone. So, the reason why it's important is because then we can get kind of an understanding as to where money is likely to flow into and out of, and what currencies are likely to flow. Money is likely to flow into and out of. And at the moment, again, we're in that situation where you could. Uh, the neutrality of it is basically just saying, well, we're not, it's not an all, nothing's an all out buy or an all out sell, right? So there are obviously opportunities in the market, but until we kind of get, uh, the volatility index kind of move maybe more towards or remain below that 20 for maybe an extended period of time, we can then start to look for more fundamental factors in terms of interest rates, interest rate divergences and convergences, rather than the market being driven by fear, uncertainty, and a flight to safe havens. So, looking at the dollar and another risk off driver, and I guess a weakness of the dollar, and what's making the dollar kind of depreciate today was really the headlines around Moody's downgrading, right? So, Moody's downgrading. The headline from Bloomberg was Moody's ratings downgraded the U.S. government's credit rating from AAA to AA1, citing concerns over the country's ballooning budget deficit and rising debt. The move has raised concerns over the U.S. sovereign bond market, with analysts warning of potential risks to the economy, including higher interest payments, weaker foreign demand for treasuries, and downward pressure on the dollar. So, the dollar at the moment has got quite a few things not going for it. It definitely needs some decent data in order to be a buy, but for now, I just think that there's too much going against the dollar for me to want to look to be a buyer of the dollar. To be a buyer of the dollar for me, the data would have to support that, right? There has to be some good economic news, some news that supports obviously economic growth, the tariffs being agreed, less risk off. But even then, there's reports, bank reports saying that even regardless of that happening, that may be more of a short-term boost to the dollar because, Donald Trump wants actually a weaker dollar. The Fed is likely to resume rate cutting in the second half of the year. So all of that is really kind of going against the dollar. So I think when we're looking at the fundamental side of things, with the price action kind of confirming this downtrend, depreciation of the dollar, we should probably still continue. The path of least resistance is probably still to the downside for the dollar. Don't get me wrong, there are probably opportunities to buy the dollar maybe at lows, but ultimately, I think if prices do pull back, that this is where I would really want to be a seller. So at the moment, any pullbacks on the dollar index, and again, you're not necessarily trading the dollar index, you're just looking at the dollar index as overall strength or weakness of the dollar against all of the other currencies. This is the equally weighted dollar index, and so if the dollar does start to strengthen without any positive news or supportive uh, news that is really kind of strengthening the dollar, then ultimately I do believe that we should be more on the sell side than the buy side. As I said, there are buying opportunities, but if I'm looking to buy the dollar, it's going to be definitely at these lows, and again, it would have to be with positive economic data. So my bias is more to the downside. Looking at the dollar yen popped up to the supply zone, probably popped above it. That was a bit of a stop hunt there, and then prices have moved to the downside. Again, this move is probably going to continue or may continue due to, of course, the Moody's downgrade. So it depends on, even though we're in a demand zone, there's no technical analysis that's going to stand in the way of investor sentiment. But to the Japanese yen, go to the Japanese yen news channel, scrolling down a bit. It says here that hedge funds and long-term investors are re-entering trades looking for the yen to rally ahead of potential currency talks this week between the US and Japan. So it says here we have seen hedge funds and also longer-term names selling dollar yen and other yen crosses, says Anthony Foster, London based head of group of 10 spot trading at Nomura International PLC. Speculation that Japan might also come under pressure to strengthen their currency has brought yen buyers back to the table. So, yeah, there's the yen is in a bit of a sticky situation because earlier last week as well, it says here that Japan's economy contracted by 0.7% on an annualized basis in the first 3 months of the year, driven by weaker trade figures and stalling consumer spending. The Bank of Japan may pause its rate hikes while monitoring the impact of the tariffs, with market expectations for another rate hike by July at just 12%, and economists warning of the risk of a technical recession. So it's a tricky one for the yen because on one hand you do have maybe some short-term potential sentiment if the bank come out and talks around tariffs and the need for the Bank of Japan to have a strengthening dollar to kind of combat inflation, but at the same time you have a situation where rising interest rates does end up contracting or can contract the economy a little bit further. So a very tricky situation. But if big money are looking to position to go long, and the yen and the dollar, I should say, is more on the some negative sentiment around the dollar, then you could look for a pullback up to this area here or anywhere and near here before looking for short trades if you're looking for a pullback. But again, it really does depend on what happens with the meeting. So really just looking for extreme ends of the range. So that would be the highs around here. If you're looking for a buy on a dollar, I don't think it would be really against the yen. But if you were looking for a buy, maybe around the bottom end of this demand zone here. And when you look at it, this would be, considered where the range is, right? Where the auction is between this low and this high. This was considered expensive for, expensive exchange rate. This was considered a cheap exchange rate. So around the 140s, 141s would be where you'd be looking for buy trades if you're interested in buying the dollar over the yen. But yeah, it does look like the smart money are looking at going short rather than going long. Looking at the dollar Swiss, now the dollar Swiss would be probably my number one candidate if I'm looking to buy the dollar for any reason. Again, we need data to support this, to support dollar buys. But if I'm looking to buy the dollar, it would definitely be against the Swiss franc. I think the Swiss franc is the weakest currency out of the currencies we trade. Any pullbacks down into these demand zones, I think, are really nice buying opportunities. But again, that would need to be supported by dollar data. Dollar CAD, again, a bit of a mixed bag. Not really a pair I'm interested in. Um, Price did kind of come up and kind of hold, I guess, around here. But this isn't really considered, I would say, a strong area of supply if you were looking for any kind of sells. If you're looking for US dollar buys, then you're looking at basically a pullback down into those lows. If you're looking for a Canadian dollar buy and go short, then I think now is now the time. Possibly, I think really the only kind of supply zone you do have would be up here. If anything, you would probably have to go into a lower time frame looking for a stop hunt above that level there, because you've got on the hourly time frame chart, you've got that level that's been touched once, twice, and then a stop hunt above that would probably be the only kind of trade setup that I could see. So that's where we are with the dollar CAD. Really haven't got a bias on this either way from a fundamental perspective or a technical perspective. The pound dollar, I was saying to the guys in the members area this morning that in fact I'm probably looking at more of a buy on this currency pair with a weak dollar or a weaker dollar and really a stronger pound. So a pullback into an area around here before looking at going long is really my preferred direction. The UK economy has been doing actually quite decent. Last week it said here that the UK economy roared back to life in the first quarter after stagnation, sort of stagnating through the second half of last year. Or did it? We're not sure. The data is an accurate guide to what's going on beneath the surface. So this is ING's opinion. It says here the UK outlook does look okay, even if first quarter GDP probably heavily overstates the underlying pace of growth. Uncertainty surrounding global trade is a headwind, though the direct impact of tariffs on the UK looks negligible. Remember, too, the government spending is rising significantly this year, and that will be a firm tailwind. So, overall, the UK, the Bank of England are actually quite hawkish. The market is expecting them to not cut rates as aggressively as other central banks. GDP is doing okay, although the data, you could look deeper into the data and maybe see some discrepancies. But ultimately, when we're looking at who's the best of the worst, who's the dog with the least fleas, it does look like the pound is the dog with the least fleas. So, I think pound buying, especially prices pull back to this 132, 150 area. I think that's going to be a really, really nice buy to go long on the pound dollar. Looking at the pound yen in a risk off environment. The yen should be really the buy, but in a risk on environment, improving risk sentiment. It looks like the yen or the pound should really be the buy based on really kind of the carry trade idea. The carry trade being that investors will borrow a lower yielding currency, lower interest rate currency like the yen, and basically put it into a higher yielding currency like the pound, and the pound should benefit from that. Now, we don't necessarily have any kind of demand zones to go off in terms of if you want to be a buyer. So you'd have to wait for prices to move higher, then pull back, creating the demand zone, and then look for long trades there. If you are looking for short trades, and this would be triggered by again some sort of global or risk sentiment, uh, yeah, risk sentiment event, then you're looking for a move back up to the 196s before looking at short trades to anticipate going short. So yeah, that's where we are with the pound yen. Looking at the euro equally weighted index, and the euro for me is a little bit more of a buy, and we're seeing that. So the euro strengthening across the board against the dollar, the pound, the yen, the CAD, the Australian dollar, the Swiss franc, and the New Zealand dollar overall. So you're pretty much buying on pullbacks, and I guess this is partly also due to dollar weakness, right? So dollar weakness, money tends to flow out of the dollar maybe into the euro. They kind of work inversely. Fundamentally, the euro isn't necessarily the greatest currency at the moment. It's just, I reckon it's just benefiting more from dollar weakness. It says here that a major European central bank has cut its euro dollar exchange rate forecast, citing US dollar trust issues. It's not the first bank to warn that trust in the US dollar has taken a hit, resulting in the currency decoupling from its traditional fundamental drivers. In the process of ramping up and down tariff rates, the trust in the US and the investment destination and business partner has eroded, something that is visible in the value of the dollar, says Mars Mouland, an analyst at Nordea Bank, in a bank detailing new downgrades for the greenback, along with weakening of the US. The euro dollar basis has moved lower. This suggests that in addition to selling US assets, international investors have started to increase their FX hedges on dollar assets, he explains. And as investors build hedges, dollars must be sold. So I'm seeing that a lot more as well in terms of investor outflows from the US, and where are they going into other assets, right? But fundamentally, the euro, it says here as well, inflation will fall below the European Central Bank's target next year because of a fallout from US trade policies, and according to the policies according to the European Commission. Now, an overshoot, or inflation falling, would mean that the European Central Bank is likely to cut rates, and cutting rates is an attempt for the central bank to depreciate their currency. So, although the euro's not a 100% buy, in terms of it's not, definitely a strong buy, because there are things going on fundamentally that could cap its appreciation. But the market sees the euro at the moment as being a bit of a buy. So if you've missed out on any euro trades and waiting for a pullback, then you'd be waiting for a pullback on the euro index before looking to get long. So looking at the euro dollar, we are starting to see this move to the upside based on, of course, Moody's downgrade, which means the euro is benefiting from that. So again, if you missed out on any moves and you don't necessarily want to buy at highs, I never advise buying at highs. Always wait for pullbacks, maybe a pullback into a decent zone before looking at going long. You also have nice support and resistance within that area, as well as confluence. So euro dollar at the moment should be probably longs. I think there's way too much negative sentiment around the dollar at the moment. But again, that could switch if the data supports or doesn't support dollar weakness. So basically, if you want to be a buyer of the dollar, you need the data to support that. If data does continues to kind of fall short, supporting dollar weakness, then of course the euro should move to the upside. I think the bigger narrative around outflows of US US investment into Europe and elsewhere is going to help support the euro as well as other currencies against the dollar over the medium to long term. Euro yen and the euro yen, again the euro kind of strengthening to a degree. I think there's probably a buying opportunity somewhere around here if you didn't get involved in buying at this demand zone. Again, probably waiting for a bit more of a pullback. um I don't really have an opinion on this. Um, Both currencies could be seen as buys in many respects. So really, you're trying to trade divergences, strong currency versus a weak currency. But from a technical analysis perspective, these highs look quite nice, or a pullback into a decent demand zone before looking at going long if you are buying the euro. I think there are better pairs to buy the euro against, and there are better pairs to sell the yen against or buy the yen against. Euro pound. So euro pound at the moment over the last week really hasn't gone anywhere. Kind of remained um, in this very tight range. And again, this is due to both currencies being kind of buys, right? So if you were looking to trade the euro pound, um, literally I think it only moved like 47 pips from the low to the highs, so there wasn't much in terms of movement. But again, that's really due to two strong currencies competing against each other. So um in terms of which currency has the edge, though, I do think the pound has a slight edge, and that's basically based on monetary policy, where the Bank of England are looking to cut less than the ECB. So I think any pullbacks into a decent zone should be looked at more of a shorting opportunity than a buying opportunity. Australian dollar, US dollar, looking at uh, again a bit of a trickier one, not a pair I'm really interested in. I think in a risk on environment, the Australian dollar should really be the buy on a pullback. With the dollar obviously weakening, you could look for some long trades now. I'd probably wait for maybe a bit more of a pullback before going long, a bit more of a bargain. Buying at highs isn't something that I do, I would recommend. But I think a pullback down into these areas here would be actually a really nice buying opportunity, as long as the the dollar remains weak. And also, as well, we do have the Australian central bank looking to cut rates, but um, the key to whether rate cuts are going to really kind of affect the currency is whether the accompanying statement from the central bank is also dovish, because there's such thing as a hawkish cut, and a hawkish cut really is central bank cutting rates, but they are hawkish in their tone, and they're indicating to the market that no more cuts are coming. So that would be more of a hawkish cut, and that is what I think the central bank, the market is looking at. So yes, we could see the central bank cut rates, and we may see a temporary pullback. But if the statement is hawkish, then in fact um, the Australian dollar should be more of a buy. But again, would I buy the Australian dollar against the US dollar? It is a candidate, but I think there are weaker currencies out there. Looking at gold. And gold is kind of benefiting from the Moody's downgrade. So you've got at the moment, yeah, gold was on a bit of a pullback, and you're looking at it from a daily perspective. Of course, gold rising due to some more uncertainty around the dollar. And if you are, short on the dollar, then you really want to go long on gold. So any pullbacks, I think, down here should be actually really nice buying opportunities. Really nice buying opportunities to look for any kind of long trades on gold with uh, dollar dollar devaluation, the dollar depreciation. Now, the S&P 500, which I apologize, for some reason it was deleted from my analysis last week. Um, the S&P at the moment is benefiting from some, obviously, the trade tariffs being a bit more certain. So uncertainty around trade tariffs not being prevalent in the market, more of a risk neutral situation. But also as well, you would think that the Moody's downgrade would be actually negative for the stock market. Now, the stock market, it says here that investors should buy any dips in US stocks fueled by Friday's credit rating cut, as the trade truce with China has reduced the odds of a recession, according to Morgan Stanley's Michael Wilson. The strategist sees a greater chance of a pullback in equities after the downgrade by Moody's rating pushed 10-year bond yields above the key 4.5% level. However, we would be buyers of such a dip, Wilson wrote in a note. And he cites that in an encouraging sign, Wilson said the corporate earnings season seemed to have ended with no major impact from the uncertainty over tariffs. A recent pickup in profit upgrades also bodes well for further equity gains, even if the coming months show slightly weaker trade data, he said. Wilson warned in March that US equity volatility would persist until the second half of the year. The strategist is now among the few voices favoring US stocks over international peers. So it seems like he still is in the minority, but um, I would probably agree that maybe there could be obviously some further downside. It doesn't seem to have impacted the market too much, but if it does look like there could be a nice buying opportunity. Also, as well, a 4.5% decrease is going to put you down to around here, right? S&P within this demand zone. So this is where the buy zone is for the S&P. Also, consider that within the second half of the year, if the Fed continue cutting rates, um, and they start to cut rates a bit more, that also benefits stock markets, right? Cheap money to reinvest in the stock market. And so this all kind of lines up actually for more long S&P 500, right? Maybe make new highs and even higher, right? Who's going to be surprised by that? But we could see obviously a move to the downside. Trading this though is going to be a bit difficult. I would rather look for long trades. I'm definitely a long S&P investor, but trading is something different. But I would probably have more of a bias to go long on pullbacks, improving global sentiment, improving risk sentiment, rate cuts coming from the Fed in the second half of the year. And so, yeah, even in a recession, the market tends to look past that and ends up, stock market new highs, right? So, definitely got a more of a longer term bias, long bias on the S&P. So, looking at my trades and a trade update. So, last week was talking about the Euro CAD going long. So, I had managed to profit off of one position, got a 1-to-1, and on the second position I trailed my stop up. There was a bit of a gap down which ended up stopping me out for my somewhere close to my original when my stop was placed originally, which was somewhere around here anyway. So I ended up breaking even on this trade. Not, you know, break even trade is fine um, on the gap. So that was okay. Euro CAD break even. Euro New Zealand, which I am still in. This was a profitable trade where I managed to get in on three positions. My original entry was here. Prices came down and down again, triggering me into my 50% positions. And then when prices moved to the upside, just took profit off and managed to win two positions. And I'm still now in this position here, right? Zooming out. So that's where I am, hoping that the euro can benefit more than the New Zealand dollar. And I'm basically aiming for some of these highs. Also, as well, I reduced my risk, I think somewhere around here. So I've trailed my stop. So now I definitely can't lose. So this is a profitable trade altogether, even if prices move to the downside. I've won two positions and will lose basically half of that one position that I have. Silver as well, managed to win one position and then get stopped out slightly on actually no, I didn't get stopped out, matter of fact. On my broker, I avoided being stopped out and actually took profit somewhere around here because I think there was improved risk sentiment last week. So I didn't think that silver was going to do well, so I ended up taking profit for basically just above break even on that second position. So yeah, I didn't get stopped out on this one. Um, but so basically, overall profitable trade, one win, one small, very small win profit. So overall on silver, that was a profitable trade. Now I didn't get into any new trades last week. I did, and I was looking to take this trade, or I did take this trade, but it went off without me. So and when I say I did take it, what happened was is that fundamentally I wanted to be a buyer of the yen over the New Zealand dollar. And we got a really nice stop hunt set up above the area, and I was in the group call with the guys, around this time as well. We were going over this trade setup, looking to get involved in this. Now, um, I had done something, come back to the market, missed my market order entry. So what I did is I set a pending order and expected price to move back up to kind of trigger me into a sell, but that never happened. So prices just went without me, hit a target of a 1 to 1, and unfortunately I never got into this trade, which was a little bit annoying because when I did see the trade, the entry was kind of like, I think it was down here, somewhere around here. And typically we do get some sort of pullback, right? But unfortunately, um, on this occasion, we just didn't get any pullback, right? That was really where I wanted to enter. Um, Prices were down here by the time I saw it, wanted the pullback, didn't get the pullback, and prices made a lower low and went to target. But not to, it is what it is, it happens. Now, what I am waiting for though is really prices to pull back up to these highs, right? And for the guys that are in in the group, will recognize this as a capture pain relief setup. And the capture pain relief setup is basically where you have traders who are caught in their positions. Capture pain relief. So I'll go over it uh, briefly. So what you're really looking at is understanding where traders are trapped, where traders are caught, right? And traders would be caught around here. You've got a level, right, and a level there, which is confirmed, right, as resistance, resistance, and then some support there as prices go down, support, and then move up, right? So you've got traders going long. Now, traders who are waiting for retracements, right, which are going to be the guys here, right, waiting for retracement at this level, would be getting involved in this based on that bullish price action, and then it fails, right? So anyone in real time who would have just seen this, right, would be getting in long, right, going long here, because that's what traditional technical analysis tells you to do. And then you get the collapse. So there's something called loss aversion bias where traders will either move or remove their stop losses. A lot of traders don't trade with stop losses. So if they were going long, right, around here, and that's where they were entering. And many of you have may have done this. Uh, as prices go against you, traders, because they don't want to lose the trade, losses feel worse than gains feel good. You basically move your stop loss further and further down. In fact, you probably may cancel it. And if you haven't blown your account, right, there's a lot of pain going on here, a lot of unrealized losses going on. And if you haven't blown your account by the time price is down here, you might have risked maybe 2% on the trade. Now down here, you're down 50%, right? 40%, whatever. The pain of going through this and nearly blowing your account, close to blowing your account, what you want to do is you want to exit the trade, right? As soon as prices come somewhere close to your original stop, right around here, rather than losing, you know, 50, 60% of your account, you know, back to 2% or 1% would be lovely, right? So you've been caught going the wrong side, gone through a lot of pain, and now you're looking for some relief, right? Some pain relief. So if prices do pull back up here, guess what's going to happen? These guys are going to exit their trades. So if they exit their trades, then if they bought here, yeah, then they have to sell to exit, which adds, supply here, right? There's gonna be supply orders. Anyone who bought down here, new traders who were buying low and selling high, right? They're gonna also look to sell. I mean, sell here and take profit, right? So you buy and take profit up here. The take profit is a sell order, so there's supply here, and then anyone who's looking at this level of resistance, support, resistance, yeah, is also going to enter into a new trade as a sell, right? So in terms of order flow, there should be sell orders around here. Different motivations for entering and exiting trades. Lots of sells around here. So that's what I'm looking for in terms of a short trade. So although we missed the original one, that's fine. If prices pull back, and prices eventually do pull back, we've got some unfair auctions here. For those who know about market making, unfair auctions that need to be completed as well. So yeah, everything around here is looking really nice for a short trade. But again, really does depend. The final icing on the cake would be whether the New Zealand dollar is a buy or a sell, or whether the yen is a buy or a sell. Because if the fundamentals flip, the yen becomes a bit more of a sell, New Zealand dollar becomes more of a buy, then I'm not taking this trade setup, right? Doesn't matter how good it looks. If the fundamentals aren't on the side of the trade, then I'll just ignore that trade and not get involved in it. So yeah, just thought I'd go over that trade setup. It's one of the many trade setups that we use, from CPRs to stop hunts. To supply and demand zones, right? Anyways, I hope you enjoyed the analysis. Take care. Have a great trading week, and I'll speak to you all next week.